All righty, folks. As I was just telling David, I am jet lagged to the point of I thought I had malaria yesterday, but we're back, and it's been an exciting couple of weeks. The nice thing about trading for a living is we can do it from anywhere. So, we were able to trade on our journey through Mexico, and had a great time just sort of unwinding, and at the same time was able to stay with the guys, and stay online with the guys, and help everybody figure out what's going on in the markets. So this particular presentation, this actually I cheated here. This is one I did at the Money Show 2 weeks ago, before we went to Mexico, or 2.5 weeks ago. But it's very, very pertinent because, as you just heard, the last presenter was talking about, the impact on the economy of all the stuff that's going on. And, those of you who trade for a living, that it has been really some big whipsaws. I think it's been the best market that we've had in a long time. We trade a lot of volatility. So what I'm going to talk about today is a group of trades that are suitable for volatile markets. It's a good way to get in front of volatility, whether you're trading it from the equity vantage point, which Julie and I do, right? We trade stocks. We trade indices. We trade the triple Qs, spiders, diamonds. We also do some futures trading on NASDAQ futures. You can do this with options. The key with options is going to be that when volatility increases, volatility becomes expensive. So you're going to have to just tinker with things a little bit so that you're getting into these positions sort of as they're hitting their thresholds, the ones that I'm going to talk to you about today. And when they hit those threshold levels, then where you capitalize is on the volatility spike right after the trade takes off. So bear that in mind when we get to that portion of the presentation. But I think most of you probably know us. Maybe some of you don't. That's my beautiful wife, Julie, and me. And we have been trading professionally since 1997. So we were working on PhDs. We were working on MBAs. We were finishing up, some advanced coursework, and we're really just grinding through a lot of data. And data is something that, of course, for those of you who have been to grad school, or those of you who've done anything like that, data is always the thing that you're looking for. And we were blessed. We were able to work with some specialist firms down at the New York Stock Exchange and get access to some pretty amazing numbers to dig into. And when we started, we were very much all about NYSE. So we didn't even trade NASDAQ. And you can see there I'm in front of, in the one picture, I was in front of the Barclays booth. My friend Jason runs that booth. He trades Kohl's, he trades Donna Karan, he trades Harley, trades Michael Kors, right? So he's got a very nice, efficient business that he runs there. And what we learned from being down there and interacting with these guys was that at that time, anyways, each stock on the exchange had its own personality because it was run by one person. So whereas NASDAQ has a ton of market makers on every stock, NYSE, New York Stock Exchange, there's one specialist, and that specialist is taking care of this particular basket of stocks, right? And he's the only guy who trades them. So what we started to get a feel for was really the psychology behind the markets. So our PhDs were both psychologists. Julie's a social psychologist. I'm an organizational psychologist, right? We're not therapists. We went into this wanting to know, is it possible to have an edge based on what you know about what happens in the markets? Now, later, we shifted gears and we started trading NASDAQ as well. And that had a lot to do with, when ARCA took over the NYSE, and then Intercontinental Exchange took over NYSE, things became much, much more automated there, in sort of the same sense that they are on NASDAQ. They're still very different animals. There's still a distinct personality to a New York Stock Exchange listed security versus a NASDAQ security. And then we also branched out into index trades. So it's been a very interesting ride. We are also the hosts of an upcoming television show called Trader Nation. So Trader Nation is again going to focus on this idea of psychology, right? Of group psychology, individual psychology, of what it takes to actually trade the markets effectively. The first episode, it's put out by Orbital Studios, right, which puts out Star Wars and The Mandalorian and all that good stuff. So it's kind of a crazy set for us to be working on. It's a little bit of an overkill for a financial show. But what we're going to do there is take deep dives into different personalities. And the first episode is called The Gamblers. And on that first episode, we have people who have been through our boot camp, and we have two people in particular, Mark Fisher and John Conforti, who had a little bit of a gambler's personality, and we talk to them about how they overcame that and how they go then and manage to work in the markets and not let that urge to let it ride or pull the lever, whatever stereotype you want to use in a gambling analogy. But how did they overcome that? How do they go and make the markets work for them? And then also you can send us a little video email if you'd like to Adrian@TraderInsight.com if you have questions. If you have a question you'd like to post for us to use on the show, and we'll answer it on an upcoming episode when we are in fact live. So it's exciting stuff. We've got a great crew of people working on this show. It's going to be a lot of fun. So all of this, though, comes from this very robust background that we have in publishing and speaking. You guys, if you've been around trading for a while, you've seen me at every one of these shows, these trade shows and stuff, going back to 1997. So I like being there. I like talking. I like publishing. I just like getting stuff out there. So we've written a lot of articles about the style of trading that we do. We've written a lot of articles that are along the lines of social proofs and data analyses that go through and sort of demonstrate why things work and what you need to do to tool up to make them work for you. We've also written, well, quite a few books, I guess, about trading. That first one on the left there, Around the Horn, A Trader's Guide to Consistently Scoring in the Markets. That one I wrote when I was in grad school. That was my project. It was a multivariate analysis of covariance in the United States equities markets was the title of the book. And, that was not going to fly off any shelves. So the publisher suggested that, we either use analogies, and I thought a sports analogy of baseball was ideal. Baseball has sort of the same psychology that trading does. Every time you step up to the plate, you've got to be fresh. You can't remember the time you struck out. You can't remember the time you hit a home run. You just need to be up there and ready to swing at the ball. And that's very much how trading is in my head. So it's not like other sports. It's not like football. It's not like a lot of the things that people normally compare things they do in life to. It's very much a mental discipline kind of a game. And if you bring that to your trading every day, then you'll manage to do well. And if you can't bring that to your trading every day, then you become one of the statistics. And the statistics really aren't good. A lot of people have a very hard time trading. The risk is difficult to manage. The keeping your eye sort of on the ball and keeping your eye on what it is that you're waiting to have happen, not getting impatient, getting things done the way that they need to be done is the toughest part of every trading day. Most people who I know who have lost money in the markets lose it because they get impatient, because they take profits early because it feels good to take a win. They take losses late because they're trying to defer the loss. All those things are the things that over time we've worked out. This is one of our boot camps, right? We do this twice a year. We love it. The funny thing about it is if you go around that room, these are all very talented people. So there's everything. I'm looking at the picture. There's everything there from an architect to a guy who had a chemical sales company, to a guy who's a cop, who's still a cop, to a guy who's a biotechnical engineer, to entrepreneurs, right? Everybody's there for the same reason. Everybody wants to learn some strategies that they can apply in the markets. And I always tell them the war is between your ears. So I can teach you the strategies. What you're going to have to do, though, is figure out what it is that's going to give you a hard time. So we do a bunch of psychological assessments, before these people ever even come. You can see there's only about 20 people at a boot camp, and we only do 2 of them a year. And we get 600 people who apply for these things. And the key, we think, to breeding success is to just go through and identify, here's who you are. Here's why this is a good fit. Here's the thing about it that's not going to be a good fit, or the things that aren't going to be a good fit. And this is where you're going to have to do some personal work in order to get to the point that trading is going to be something that can be a career for you. We meet a lot of people who've been trading for 15, 20 years. And when we talk to them, they say they're not making money. And that's a long time to sort of, make some lose some, make some lose some. I mean, you can go through and you can determine what it is that's going to make you successful. And then you can figure out how to work with your psychology to foster that success. So that's the point of this program that we do. We work with these guys for a year. We make it a point that all the material they're going to be in front of is very, very relevant. We talk to them constantly. It's really good. It really gets your head in the right place and gets you working in a way that enables you then to be profitable in the markets. So it's been an amazing experience for us. We love it. It's the closest thing to going out and doing what we thought we were going to do to begin with, which was be professors at a university. This is really great, and it's got some real world stuff going on that you don't necessarily get at a university when you're teaching classes. So one of the things we try to foster with these guys is you need to understand the market that you're working in, and you need to create a roadmap. And right now, the roadmap is all about the volatility. So when you have news-driven markets, when you have geopolitical stuff going on that really drives the action, the price action in the markets, you need to figure out how you're going to go through and isolate volatility in such a way that, based on what your bias is for the day, so let's say you have a long bias going into the session based on the chart that you were looking at, or you have a short bias going in, you know exactly what price level everything that you were going to do is going to happen at, and you know exactly the direction of the trade. You can put the trades together ahead of time, right? So we do everything with bracket orders. So everything is effectively a stop limit order, right? Or a limit order, depending on which direction price is coming from. And what it does is it sets the whole trade up. So your entry is defined, your slippage is predefined, your exit for a loss is predefined, and your exit for a profit is predefined. And then what we don't do is go and second guess the outcome of the trade. So we set it up ahead of time, we limit our decision making, and then at the end of the day, there's no good days, no bad days. They're just days. You're doing the same work every day. You're getting ready for tomorrow. And once tomorrow's here, you know what you're going to do, and you don't wind up trying to shoot from the hip. So your decision-making process is all set up ahead of time. So we're on the West Coast. All right, we're out in Pacific Palisades, which is Malibu, California. If you can imagine, how far we are from New York time zones here. The only thing worse would be Hawaii. I don't want to make decisions on the fly at 6:30 in the morning. That's one thing if I'm in New York, but it's something totally different when I'm doing it here on the West Coast. So I like to have this stuff set up ahead of time. And it's pretty basic in terms of what I'm looking at. Now, some of you are going to look at this and say, well, you make it sound easy, but that's not really basic. It's a lot of pattern recognition and understanding what's going on in the markets, but just break it down and ask yourself, can you, when you look at a chart, can you see the support level that's drawn right there? Do you see why that's an active support level, why there's order flow there? So we're order flow traders. We're not really directional traders. We're taking very small slices of what's going on in the market over the course of the day. And we're just trying to capture the order flow from one price level to the next price level, and then to the next price level. And the way that we're isolating this volatility is we're looking at the actual prices, We're looking at where those bars are forming support. And so, somebody always asks why I use bar charts instead of candlesticks. Julie uses candlesticks. I use bar charts, always have. It's just force of habit, right? But for me, it's just easy to go through and identify on a chart like this. Now, this one's Netflix, and then I'll show you the example of NVIDIA, and then we'll come back to Netflix so that you get an idea for a couple of these. It's easy for me to identify those directional levels, right? Those absolute levels that are threshold levels where price has gone and it landed. And it's very, very helpful if you have access to a piece of software that can do this kind of a thing. This is Realtick or ES now. And if you look out on the right axis, what you see are the volume by price thresholds. And that's an algorithm that goes through and identifies pockets that represent where the order flow is. So if you look at the price levels that I've identified, and then you look out to the right side there, what you see is the price levels are confirmed by those volume by price thresholds. So we get a double confirmation that there's something going on there. There's a very high likelihood that if tomorrow we get into this range, we're going to see a move down to here again. If we get into this range, we're going to see a move down to the next level. And if we get into that range, we're very likely to see a move down into this bottom for a retest. And this is one of the trading plans that I set up every night. So all my guys are looking at this every day. And there's 3 stocks on this trading plan. So actually 4. There's also a big sheet of Apple, like all the different threshold levels for Apple. But all we're doing over the course of the day, you can see there's the Netflix one that I was just talking about is in the middle there. Let me pull up NVIDIA here. You can see again, I've got a position again, it's going to be a short sale. I'm looking for that first bracket is 134.26 down to 55, 133.55 down to 2.81, and then 2.81 down to 1.67. So those levels are the levels that I'm expecting this stock to move through if it comes into them from above. So I'm always looking for this thing to start at the far end. I'm looking for, is it above 134.26 in the morning? And if it is it making sort of a shallow move down into those? You have to be able to identify price action. It's not easy, but it's easy enough because it's putting you in front of the opportunity. And all you have to see is, am I coming into 134.26 from above? If I am, I don't want to see it be a real big bar. I don't want to see some $3 move in one bar. I want to see the bars getting sort of tighter as they get to that 34.26 level. And then what I'm expecting is, if I get into those ranges, we're going to move all the way down through all the levels that we've identified. And let me go back to Netflix here and show you, this is the one that we were just working on. So you can see we had 297.70 at the top, 296.93, 96.11, and then 5.04. Those are the levels that we had identified the day before for this particular day's trading. And these happen every day. Right. So we had them today. We had, Microsoft, Netflix, NVIDIA, and Apple that we were working with during the session. But what you're looking for is, as soon as that opening volatility settles in, it's not like a first 5-minute trade. This is much more 10, 15 minutes into the market, we start looking at this. You've got now a handle on the pre-market news. You know where the futures were trading. If we're down 120 points, 130 points on the Dow futures going into the session, no big deal. We know that kind of volatility is just to be expected right now. If we're down 600, 700 points before the open, it's a different story. I'm going to pass on these trades. It's just going to be a day that we don't take them, and that's all right. You don't have to do it every single day. We've got lots and lots of trades on our trading plan. We have these 4, and then we have additional trades from the Around the Horn plan. We have additional trades from another volatility-based plan that I put out. So I've got all this stuff bundled up and ready to go first thing in the morning. And when we open our trading room, the first thing we do is just have a quick review with everybody. Here's the game plan for the day. We're going to avoid the Apple trade because Apple is, way down or way up in the pre-market, and it's not trading nicely. It's having, wild swings in the pre-market, or looks like Microsoft's going to come into the bands from the proper direction. Looks like Netflix is coming in from the proper direction. Let's keep an eye on those. Let's also watch for the following, for these opening gap trades that I'm going to show you in a second here. But you can see here, this is very typical. Once we get sort of that first relatively wild swing in those first 2 bars out of the way, we start to see things tighten up. And we start to see a very logical progression down into our levels. And over the course of the morning, what we wound up doing here was 2 times through all the bands. My guys and us too, we always love it when they run the bands once, but we love it even more when it runs them twice, right? And that's 266 a share each time that it does it. So you can do this with stock, which is what Julie and I do. You can do this with options where you're going to go and you're going to focus more on, am I coming into one of these threshold levels? And then can I get a pickup when the volatility starts to increase? Can I get picked up with a put? And then you're just looking to capture the range of the move and get out on the other side when volatility starts to settle back in again. So it makes for a very organized, very stable kind of a trading day. We also do the Qs. Like I said, same thing. All right, so look at the triple Qs here. I go through and I identify over the course of early trading, really. I go through at about 8:30 a.m. Pacific time, and I start identifying where are things settling in. Where is price relative to the central pivot? Where are the anchored volume weighted average price? So you see those orange lines on the chart, those are anchored VWAPs. So what those are doing is taking each one of the trend moves and isolating it and saying, what was the volume weighted average price for the move to the downside from time 1 to time 2. So as you're going down through here, what you want to see happen is we're also seeing a confluence of indications. So we've got anchored VWAPs, we've got natural support and resistance. And all the way down this chart, we see that these things are overlapping with some very predictable certainty. And that gives us then threshold levels that we can go back to and say, those are the places we're interested in establishing a position. So in this case, when I see price coming down like this, and I see that the trend on the day is lower, what I'm actually looking for are these pops back to the upside that get us into one of those overhead bands, right? The support and resistance bands. And then I'm always looking to capitalize on the directionality that the stock has had for the day. Stock is net negative on the session. Stock is net negative on the day. We've got a clear downtrend at that point, and that tells us the best bet is going to be taking a position that moves us lower. And this one is very easy to do with futures too. So you can get a lot of leverage out of futures, so be careful. I tell my guys, just set it up like a stock trade, even if you're trading it on the future, and then just tell yourself, here's what I'd be willing to risk on the stock if I was going to buy shares. So that's the amount I'm going to risk on the futures, because cowboys get killed. So you just always want to stay on the most comfortable, psychologically speaking, kind of a plan for yourself. You don't want to put yourself out there with more risk than you really want to be able to accept. Here's another one. Comes up, hits that VWAP, right? Back down again. These are tight ranges. I mean, these are, 277.73 down to 7.18. And the first one was 8.08 down to 18. But look at them. I mean, it's you do this all day long, and over the course of the session, you get lots of opportunities, even when the trend changes, right? You get lots of opportunities to say, now the thing's in a bit of an uptrend. I see this move back down right to my support level. This is where, over the course of the day, what I'm doing is I'm sending you guys out these videos. So all you guys who are on with us, you get a text message. Email doesn't work because people forever complained that they didn't know when the email was coming. So we switched it up and we do it as a text message, and you just get a link to a Vimeo video, and you click on it, and then here's my game plan. Here's what I'm looking to do. Not because I'm smarter than anybody, but because it helps to have somebody else's ideas in front of you, just in order for you to get a reference on what it is that you are thinking about. So it never hurts to compare what you are doing to what Julie and I are doing, and just see, do those two things overlap? So that is a basic view of how these, this is actually a trading methodology that, we've got a 20-hour course and a live seminar that we do built around, because there's so many little variables that you can look at. But this right here, this like 30,000 foot view of how to set this up, this will get you going. And at the end of the presentation, if you want to sign up for, there's no credit card or anything. If you want to sign up for a 2-week, or it can be 4 weeks if you want it to be, trial to take a look at what we're doing, do it, and then just compare it. Go compare it to what it is that you were thinking, and just see, is this something that's a good psychological fit for me? And if it is, you add it to what you're doing already. And if it isn't, you do something else. Right, so this is all the stuff that I tell all my guys all the time. There's lots and lots of ways to do this. You just have to find the thing that works for you. Now, I told you in the original version of my first book, it was all about multivariate statistics and statistical analysis, and that wound up being replaced with a bunch of pattern recognition, because really I found you don't have to go and crunch a ton of data every day to figure out what's going on. Once you're used to looking at these things, once you're used to seeing the patterns, you can tell what's going to come next in the market, and more times than not, you can be on the right side of a trade. We do have one trade that I left the whole statistic in the book for, because it's a simple statistic. And this one, I told you everything is written around a baseball analogy in that book. I don't know that I would do it again, because I over anticipated how much other people were fans of that sport. I love it. We're big Dodger fans, so for me it made perfect sense. A lot of other people are like, well, I'm not a baseball fan, so what's an infield fly? But I left the statistic in for a trade that I call Baltimore Chop. And this is a 2 standard deviation gap reversal. And if you're into trading gaps and you're looking for the opportunity to fade over reactions in gaps, or if you ever have a question as to whether something's a gap and go or it's a gap and fade, then this setup can change your life, right? This is going to be one. You can take this thing, you can put it to work tomorrow. There's no secret here, no black box. I'm going to show you exactly how everything's calculated. And you can go through and pretty much put together a spreadsheet to calculate this stuff for you. Or you can use ours. We've got a scanner that you can look at, right? I'm not saying, don't use a tool if it's available. I'm just saying this is not a black box. This is not a secret. I want to show you exactly what I'm thinking here and exactly how this thing works. So why'd I call it Baltimore Chop, first off? So Baltimore Orioles, the old Baltimore Orioles, not the new guys, they had a trick. And the trick was, when they had a slow base runner at bat, which they had plenty of, they taught these guys to hit the ball and spike it down into the ground. And it would pop it over the pitcher's head, and your batter could make it to first base before the ball could be fielded. And you're going to see in a second here why I think this pattern looks an awful lot like that particular baseball play. So when we started doing this, we used the implied volatility of the front month contract for every single stock in the S&P 500, S&P 400. Had to gather that data every day. If we forgot to gather the data, we were done, right? The next day already, the data was no good, and I had to wait 10 days to get a robust enough data set to do the analysis. And then we figured out that really, anytime you're using a statistic to begin with, right, what you want to make sure of is the thing that you're measuring is actually the thing that you're interested in measuring. And when you're doing gaps, the volatility that you're interested in is that gap volatility. So what makes for a really good proxy for implied volatility is true range. And we've done a bunch of research on this, and it's worked out really well for us over the years. We've been trading this particular pattern for, I guess, going on 26 years now. And the first thing to bear in mind is what's range and true range. So let's make sure everybody's on the same page. Range is just the high minus the low. So whatever, if that's a candle or that's a bar, whatever you want to look at, it's the extreme to the extreme. So the high minus the low. In this case, if the high was $50.10 and the low was $49.40, you had 70 cents of range for the day. That's pretty much a basic one. Everybody understands that. True range is a measure of the thing that we're interested in, though, because true range includes the gaps. So stock's true range today is the greater value of the high minus the low, or the high minus the previous close, the absolute value of the high minus the previous close, or the absolute value of the low minus the previous close. And what that does is it factors the gap into your calculation. So if that's the high, and you have a previous bar, and you subtract the close from it, your true range is going to be $50.10 minus $49. So that same set of bars now has a true range of $1.10 for the day, because you're including the gap. You've included the gap from yesterday to today, and you're going to look at this for 10 days rolling. And we're going to do a very simple statistic on it just to find out, are we out in the tails of a distribution? I'll show you why that's important in 1 second here. I've got some assumptions. First one is our data is normally distributed. So I can tell you for a fact, volatility data is normally distributed. True range is a proxy for volatility. I've been doing it for 26 years. You got to trust me here. True range is a really good proxy for volatility when it comes to measuring gaps. And volatility is mean reverting. So there's a ton of studies out there, a ton of research out there that proves volatility is in fact mean reverting. What all this gives you access to is this guy right here. That's a standard normal distribution. You've seen this on the news. You've seen it in your statistics classes back in college. What you know about this thing is right in the middle, that's mu. That's the arithmetic average. That's the mean of all the data. If you go, it's called one standard deviation, out on either side of the average, you've accounted for 68% of the volatility that you're going to expect to see. So now you've got 68% has been accounted for. And what that says is not that you're 68% certain it's coming back to the average. It just says you're 68% certain it's not going to move any further, or it's going to start drifting back towards the average. The best part is if you're 2 standard deviations out, now you've accounted for 95% of the variability that you're going to expect to see in the data that you're looking at. So look at this. What's this say to you? So what's a standard deviation? First up, a standard deviation is really how much on average can we expect things to move away from the average. So how much on average can we expect that price in this case is going to move away from that true range average? And what you want to make sure of is when you plug your true range in your trading software, that you're using true range, not average true range. If your software only has average true range, then just set the look back period to 1 day, and 1 day average is going to be of that 1 day. So it's the same thing as just saying true range. But what are we expecting to see here? You've got this data, and right in the middle, you have that average, right? So there's another way of just looking at that bell-shaped curve. And when you're out 2 standard deviations, that represents high volatility. Now you're in high volatility. You've moved away from the central tendency. You've moved away from the average. And what you're going to expect to see happen is we're going to see mean reversion. So the data is going to do something. We don't know, is it going all the way back to that average line, or is it going below the average line, or how much is it moving? We're just focused on when we get the high volatility periods, we want to know what's the probability that we're going to revert towards that mean, because that's where we have the opportunity for a profit. So the formula is simple. It's actually a simplified version of a standard deviation calculation. So down on the bottom there, in a normal calculation, you would have n minus 1. We don't need to worry about degrees of freedom here. In this calculation, what you're looking at is x. So for 1 to 10, that's each day's true range. So you're just going to go day 1, day 2, day 3, day 4, day 5, day 6, right all the way to 10. And then from each one, you're going to subtract the average true range. And then you're going to square each one of those numbers to get rid of a negative number. So we're going to sum all that. We're going to divide it by n, by 10, right? 10 days or the 2 weeks is the amount of data we're looking at. We take the square root, and what that gives us is 1 standard deviation. So look here, you've got a table. And this is what I was telling you. You can just plug this in. If you're good at math and you're good at putting together descriptive statistics, you're good with Excel, you can just run this data out of your trading software, get it into a spreadsheet, and then for each stock, you're going to have to just tell it to update it every day. For each stock, you're going to take the true range value for each one of the days, and you're going to plug it into that formula. And what you're going to get when you put X minus X bar in here, right? So X is each one of the values. X bar is the average. So it's just 1.25. That's the arithmetic average of day 1 through 10. So you take all those numbers, add them together, divide it by 10. That's what that X bar stands for. And once we divide it by n, and we take the square root, what we get is 1 standard deviation. So 1 standard deviation is 49 cents. 2 standard deviations is just 2 times 49, and I get 98 cents. The average is $1.25. So you take $1.25, you add 98 cents to it, and that's a 2 standard deviation opening gap. And that's the magic number that you're looking for these gap reversals. And here's why it looks to me like that Baltimore chop that we were talking about. Let's say these are 5-minute bars. So you're looking at 5-minute bars going into yesterday's close, and then you got the 5-minute bars going into today's open. And that is your gap. And now your software lights up and it says, that's 2 standard deviations. Excel tells you you've qualified it. You made a 2 standard deviation move. What we do in the most, again, this is as complicated a trade as you want it to be. This is the easiest version. And this is by far and away my favorite way to trade this thing, is with these 1, 2, 3 kind of stair step moves. And what I mean by that is when you're looking at this chart in the morning, all that you want to see is, am I getting a move that gives me a threshold high, right, for each bar? So each one of the bars on the chart, we're looking to see bar 1 closes, bar 2 opens lower and closes lower. So now we've got a high of bar 2 that would represent for us a trigger for an entry. So if bar number 3 trades up through this level right here, then we're going to look to enter in bar 3, right, as it moves up through here. But bar 3 doesn't move through there. So now what we do is we say, well, okay, what about bar 4? And if bar 4 is the bar that gives us the trigger, then that's going to be our entry. But in this case, it's bar 5, right? So we've got 1, 2, 3, 4, a nice little stair step down. And then we've got this threshold is violated by the next bar. It looks like a garden variety pullback. Somebody always asks, how do you know it's the lowest? Because you're constantly moving your order down. So in bar 2, you already know, okay, if bar 3 violates the high in the next 5 minutes, that's where I want to get in. And you just keep moving that down. Now nope, bar 3 didn't do it. Now move it to bar 4. Now move it to bar 5. And eventually by 7 a.m. Pacific time, we've made the decision to get in or not get in and just pass on all of them. So 10 a.m. Eastern, 7 a.m. Pacific is the cutoff. And that's because the data starts to skew. So your distribution starts to move on you, and you don't want to be part of a skewed distribution. So it's good for about a half an hour of trading, and we get pretty much, I'm going to say 6 days out of 10, we get an entry on one of these. And what you're going to do is target something significant in the first bar of trading. So in this case, what we targeted was the open of bar number 1. And what you're looking for is always, where did something significant happen in bar number 1? And the reason that I would pick in this case the open is after that open, it just tried to tick up, it couldn't, and then it slammed down lower. So when I get back there again, my best expectancy for what price is going to do is it's gonna plummet right back down again. The market maker or the specialist is going to be sitting there. That's where he had order flow in the morning. That's likely going to be where he has order flow again. And that's where, we want to get out of the trade for a profit if the trade is moved in our favor. And generally speaking, in the case of a long like this, the entry bar low would be the threshold that I used for stop loss. And you can see here, the reason I called it Baltimore chop is it looks a lot like spiking that ball down into the ground and having it pop over the pitcher's head. So how do you find these opportunities? As I said, you need to put yourself in front of something that's going to give you clarity as to what's going on. And we ported this into a spreadsheet. So what happens is it's pulling all the data from Realtick. So we've got an API that goes and pulls that data in, and it says S&P 500. That's the left column there. S&P 400. That's the middle column. And then are they in the news? That's the right column. So it goes through. It's looking to see, is this thing being covered by Bloomberg, this gap this morning? Is this being covered by the fly on the wall? Is this being covered by Reuters, right? Is it getting wide coverage in the financial stuff, or is it something that's just sort of dead in the water, nobody cares? Those are the ones that get moved to that right column. So you'll see there's overlap. Right? They're from S&P 500, they're from S&P 400. They get moved to the news column when there's news. That's how you sort through when there's a tremendous amount of data like this. You want to shift your attention over to the far column and narrow this down as much as you can. Then you can see there's, in this case, on this particular day, they all had an asterisk. That's not usually the case. What the asterisk tells you is it in the news because of earnings? Because what happens with earnings is, statistically speaking, the gap that a stock makes on the heel of an earnings announcement is usually too large to be justified by the earnings. And it tells you right out of the gate, these are going to be stocks that have good potential. So we focus on the ones that are in the news. We focus on the ones that are marked with an asterisk. We want to make sure that the news that we're watching is something that's run of the mill. And by run of the mill, I mean, you don't want to find out that the CEO or the CFO stole a bunch of money or killed somebody or woke up in the wrong person's house. That happened last week. And those are things that are going to materially shift a company. Those skew a distribution. They change the picture. If the CEO is a goner, if he's leaving unexpectedly, then that's going to be a distribution that's shifted. And that makes it much, much harder to figure out whether or not you're looking at something that's real and that's going to revert, or if you're looking at something that's extraordinary and is going to wind up, making for. I tell people all the time that story's always got a beginning and an end, and a bunch of stuff in the middle I don't like. So I just try to focus on the ones that are very, very much run of the mill. Also, if you take the trial to our trading room and our services, like I said, there's no high pressure. Just if get yourself in there if you're going to be there and take a look at what's going on, because too many people sign up for stuff and then don't ever go and even put their toe in the water. They don't ever try it. They don't ever look at what's happening. And it's a valuable coaching experience just for what it is, right? So it's just a half hour of your morning right when the market opens. On these charts, on the spreadsheet, what you'll see is the ones that Julie and I are going to trade light up. So they light up in yellow. So there's a list of stuff to go through here, but there's also a limited number of things. Usually it's 1, 2, 3, right, of what it is that I'm actually going to be trading. So we fire those off. We do trade live every day, and we take these positions because this is our bread and butter. And what you're going to see is, in this case, it was AbbVie, right? So AbbVie came up. This was the gap on this particular trading session. Again, we've been out of the country, so I apologize for not having some fresher charts. I usually try to get these up to the minute. This morning, if you want to look, we had Target. So we had Target that was a flip top. We did really well with that one. That was $1.80 per share move on Target. But this one is AbbVie. And like I said, on this day, this was marked. And it was because we had that gap open. Then we had a shift lower, right? It's 2 standard deviations. It's got all the hallmarks of a good mean reversion. And you can see that as it moves down, moves lower, lower, lower. Once we get down into this level right here, we've put in the lowest high the stock's going to put in. And now what we're looking to do is get long on a violation of that bar right there, right, the 955 bar. And you're getting long. And then what are you going to do? You're going to target something significant that happened in the first bar of trading, or in the first couple bars of trading. And if you look there, it's pretty obvious. If you look at the volume by price data, if you look at what happened in that bar, you see that big spike to the upside, and then it just drills back down again and closes right there. And then from there, it falls lower in bar 2 and bar 3, bar 4, bar 5. It just keeps moving lower. So I don't want to be long that stock when we get back into that closing price of the first bar. I don't care how far it goes without me. What I care about is I've got some very mechanical logic that I can apply to these things, because what we're doing is we're just shifting the order the whole time that this trade is maturing in the morning. What we're doing is going through and just saying, okay, we're going to set up a bracket order. So, how many shares you're going to trade, that's up to you. I would, it's whatever you're comfortable trading. What I tell people all the time is don't change the stop loss, change the share size. Just figure out, if your comfort says, I don't want to risk $500 on a trade, I want to risk $100, then you pull those shares back, right? You pull it down until everything makes sense and you can allow yourself to follow through with what you've said you're going to do. Let's see in this case, right? So we've got 146.50 is our long entry. 146.50 is our profit objective. 143 is our stop out. We've got all this stuff set up here. The stop price is the activation price, right? So somebody asked me, is that a stop loss? No, that's the price at which you're going to go long at 144, and in this case, you've got a limit of 144.05. How much slippage are you going to allow? Because you're going to get it, believe me. Whatever the slippage is that you're saying you're willing to accept, that's the slippage you're probably going to be accepting. But in this case, 144 up to 144.05 is where I want to buy. I want to sell for a profit, 146.50. I want to sell for a loss at 143. And then you can do 2 or 3 of these trades at the same time, because what you're not doing is babysitting each one of these positions. Because what happens is people focus too much on this and they want to have that up on their screen. I tell people all the time, if you got your P&L on the screen, as far as I'm concerned, you're already done. You've set a hurdle for yourself now that's going to be very impractical. It's going to be very hard for you not to look at that particular trade as it's going on, when in reality, what effect does you tinkering with this trade have? It's not going to be good. I mean, you set this thing up the way that it needed to be set up, and the only thing that you're doing when you brood over this stuff, you're sweating every tick on these trades, is you're messing with your own psychology. It just makes it harder and harder and harder for you to go and trade your plan the way that you put it together. So I put these out like this in the morning, right? I just put a live bracket on it. I'm just measuring for each one of these things. All you need to do in Realtick or ES is turn on your chart trading, and then you can just click on the line when it's on the screen. You can just keep pulling it down, pulling it down, pulling it down until you get to that bottom, the bottom bar, and your trade will be automated. Makes it very, very easy to go through and manage these trades. All right, so that's really it for me. I mean, I wanted to look at how it is that we're handling all this volatility. What it is that we do each morning. Like I said, Julie and I have been trading for a long, long time, and we love it. You can join us. Visit TraderInsight.com/morning, and you can sign up there. Complete. There's first name, email, and a phone number that you can get a text message at. But the text message is I don't sit here all day typing stuff into the computer. What I do is I send out a video update once at least, sometimes twice a day, that says, here's what I'm looking at now. Here's what I'm doing on the Qs, right? Here's what I'm doing on the volatility band setups. If you get that text, just click on it. It's a Vimeo video, and it'll pop up on your phone. It does not work to send them by email, because people say, they don't know when the email's coming, or it's frustrating because they're anticipating the email and then the email doesn't come, or the email comes late, or whatever. So it's just been a lot easier for us to send those updates out via text message. Okay, so does anybody have any questions? What channel will this air on? So right now, what I know is, the studio that we're working with is Orbital, and Orbital is shopping it to the networks. And It's going to be a weekend show, so it'll be a Friday night show. It'll run again on Saturday, and then it'll run again on Sunday. That's how the syndication is going to work. Will it air on CNBC or NBC or ABC? Quite frankly, it's going to air wherever they manage to get us the best deal. But we've got some of them in the can already with with just the psychology stuff, and that's going to be the key here, right? It's very, very interesting, sort of this face of trading thing, right, where you get to see how other people overcome things and how other people got good at what they're doing, or some cases how they decided that it wasn't for them, I guess, but most of them got very good at what they're doing. Anybody else have questions? Yeah, you can check our webpage for when it's going to run. I know it's not going to be before late January of 2023. So you can apply, it's the volatility stuff. If that's what you said, the gaps, you're not going to be able to apply on anything that's a continuous market. So anything that's trading 24, you have to be able to isolate. For the statistic to work, you need to be able to isolate a session, right? There's got to be like a cash session in order to spot it. But if you're talking about the volatility bands, yeah, you can, as long as you can see order flow, as long as what you're trading is not some illiquid currency pair that only trades in the middle of the night between, two people or something, as long as it's very liquid, you should be able to apply that same logic to whatever it is that you're doing. Anybody else? All right. Well, thanks for coming. Thanks for taking time out of your day to listen to my ideas. It's this has definitely been an interesting ride. This is this has been our life's work, is working with the markets and teaching other people how to work with the markets too. And boy, we love it. We just really love what we do. And again, if you have questions later, you can. I'll put an email in here for you. So it's just Adrian, Adrian, at TraderInsight.com. And if you guys have questions, or there's something that didn't quite make sense, or there's something you want to dive a little bit deeper into, feel free. You can shoot me an email, or you can also just you can shoot me a text at there you go, 310-804-2248. Just don't do it in the middle of the night, because that's my personal phone. But I almost prefer to get a text. I'm like most of our clients. If the email comes, we're likely to miss it. So you can just shoot me a quick text message and just say, hey, I've got a question for you. Do you have time for a quick call? Okay.